All right, so I wanted to provide an update. So number one, our March rate and market update, and want to also provide an update on what's going on in the market. It's been a crazy couple of weeks, and it's definitely starting to show some cracks in both the banking system, and we've also got some cracks in the jobs report and what's going on in our economy. So let's start with the jobs report. As we talked about last time, jobs report had some huge seasonal adjustments that we just didn't understand where they came from and why they were so large. But there were some revisions to that report, about 34,000 jobs that was revised. But the biggest thing is data is starting to show that hiring is cooling down, okay? So data shows that individuals that are laid off are having a lot harder time finding a new job. It's taking longer than it typically does. Along with that, hours worked are declining. So what are employers going to do before they lay off people? They start to cut hours. So both of these things are leading and kind of predicting that unemployment is going to start to go up. And why is that important? Because if you look back at history, every single recession, we go into this recession when unemployment is at its lowest point and it starts to tick up. So the recession's coming if we're not in it already. And that's a big thing. So we wanted to talk about that jobs report and bring that into consideration. Now, the good thing is a recession is actually good for the housing market. Outside of 2008, which has to be taken out because the recession was caused by the housing market, every recession in history, what happens? Rates drop. Demand increases, which means prices increase. Your home price will not go down. It will go up because it's cheaper to buy houses, so more people buy them. There's still a limited supply, so more people buying less homes cause appreciation, causes prices to go up. Simple supply and demand economics. Now, let's talk about the cracks in that banking system. Within the banking system, we obviously, if you haven't heard, Silicon Valley Bank is in failure. And really what caused that? Well, number one, I want to start with the Feds. Number one, they were late to the party, okay? They started increasing their Fed rate too late, number one. And number two, they also did it too fast. And the last speech that was given said, what? I want to see pain. Well, guess what? You got it, okay? Now, let me explain a little bit about how banks work. So banks take your deposits, and they give you a small rate of return in order to use that money, but then they lend it out and they hope to make a spread in between. Well, what happens when the Feds jack up rates so quickly, it causes short-term yields to be higher than long-term yields, which completely evaporates the gains that they were expecting to make. That's not good. Number one, obviously it erodes their profit because now they're paying people on their deposits more than they made. Not a very good business plan if you ask me, number one. Also, a hike in long-term bonds caused, and the rates rising, that caused the same effect to happen. It made their investments worthless. Why? Because if I am holding a bond with a 2% yield and now there's a 4% yield available, my bond is basically worthless, right? Because I can go get a 4%. Why would I take a 2% yield if I can get more? Investors, it just doesn't make sense, right? So when this happens, those two things happened. So their assets, the value of their assets started to go down dramatically. When this happens, guess what? It causes a bank run. You may have heard that term. Everybody runs to the bank to get their money out. Well, with banking rules, you only have to carry 10% of the amount you have in deposits on hand in cash. So if everybody runs to the bank and gets their money, guess what? The bank doesn't have any money to give, and you're out. And this is what causes the bank to fail. And it continues to exacerbate the problem. So, yes, is it an issue? And are we going to see some continued collateral damage from the Silicon Valley Bank and the other banks that were involved? Absolutely we will. And unfortunately, it's going to heavily affect the tech sector and also cryptocurrency. So it's definitely going to have an effect on us. Now, in terms of the recession, housing market, and interest rates, it's actually going to help interest rates. again, recessions are good for interest rates because they come down. Inflation comes down during a recession. So a couple of reports that we want to be on guard for. So next week we have Tuesday is the CPI report. So that's one of the big reports that we want to watch for inflation. Inflation is tied directly to mortgage rates, so we want to make sure we pay attention to that. Wednesday, we've got producer price index, but we also have the Fed rate decision, of which their comments are going to make a huge impact on the market. I highly doubt they're going to do a 50 basis point rate hike. They may not even hike rates at all. Do they need to? Probably not. I think we can let this play out, and I think everything's going to be fine in my opinion, but you never know. So we have the Fed rate decision. All eyes are on that on Wednesday, and then Thursday we have jobless claims. So jobless claims, again, jobs report is huge. That is one thing we want to keep an eye on, because unemployment ticking up is what's going to signal we are in the recession. And the faster we can get into it, the faster we can get on the other side. So just a ballpark idea of what's going on in the housing market, but also wanted to make a quick note. I did have a smaller video that I put out earlier about this, but wanted to remind people what happens if you buy a house at the peak of the market. And the reality is nothing. Nothing happens. Nothing happens at all, because you don't buy a house to live in it for 6 or 12 months. If you're flipping, that's a totally different strategy. But if you're buying a house to live in, nothing's going to happen. You continue to make your mortgage payments, and everybody's fine. Everything's fine. Eventually, the home price will equal what you paid for it and continue to rise. If you look at any investment, long-term investment, what happens? Look at the stock market 20 years ago compared to where it is today. Guess what? It goes up. It continues to rise. It will continue to go up. We're not going to see the appreciation that we saw over the past couple of years, but guess what? Appreciation, seeing some, is still not depreciation or the loss in value. So your property is still going to go up. It's still a fantastic time to buy. The best time to buy is when you're ready. Don't let the media scare you. Don't let what's going on in the economy scare you. It is a good time to buy, because you're still taking money out of one pocket and putting it in another, because you're paying down that loan. Even if the property didn't appreciate $1, you pay down debt. When you rent, guess what? You get nothing. So at least you have some exchange of money. Thank you so much for watching. I hope you have a great week. Just let us know. Let me know if there's anything I can do to help you. Make it a good one.